you need a better type of annuity generating asset or a better appreciating asset, and that's where Bitcoin comes in. You don't just snap your fingers and change those structures in a day or a week or a month or a year. Then every insurance policy you issue or annuity that you sell based on Bitcoin becomes a Bitcoin derivative. So if I want to sell you life insurance policy that pays off $1 million when you die, and I'm going to charge you X premium, right? I got to charge you enough premiums and invest them to pay off the $1 million. So if I charge you those premiums and I invest them at 2% yield or 3% yield, it's kind of hard to pay off the million. I have to charge you a high premium. Whereas if I charge you premiums and invest them in Bitcoin, I can lower the premium, or I can raise the payout, or I can make the payout variable. So now you've got an insurance company that's created a differentiated insurance product, and you can either do it explicitly. You can do it explicitly by offering the policy backed by Bitcoin, or you can do it implicitly on your balance sheet. You could just take $50 billion of your balance sheet that are your collected annuities or premiums, and you could buy Bitcoin with it and use it collectively to back all your policies at the corporate level. And of course, insurance companies have long durations. They have to look out 30, 40 years. They're in business forever. They have huge balance sheets, and their traditional funding vehicle is bonds, and bonds are broken. And so you need a better type of annuity generating asset or a better appreciating asset. And that's where Bitcoin comes in. And that's where investment firms come in. I mean, my next application, you got an investment firm and you sell mutual funds or you sell investment funds and people invest with you. So if you create the fund based on Bitcoin and then you sell that, that becomes an instrument that's interesting to corporate investors, family offices, individual investors. There's a lot of people that will want to buy that fund, and there's an entire industry that sells those funds. There's also an interesting hybrid twist on that. Like if you look at Fidelity sells all sorts of fixed income funds, municipal bond funds, sovereign debt funds, corporate bond funds, junk bond funds. They all have a low yield and they've got a negative real yield. Well, you can juice them by blending them with Bitcoin. So if I have an instrument or an asset that's been going up 100% a year, and I blend it into an asset that's been paying 3% interest, now I created a hybrid instrument that's got downside protection of bonds, but upside opportunity of something. So for an investment fund, you can blend various types of funds. What if you're 50% Bitcoin and then the other 50% is Bitcoin derivatives, call and future caller options? Maybe you caller the Bitcoin, or maybe you're 50% Bitcoin and then you're selling covered calls out of the money to generate yield. So you're creating a Bitcoin yield fund. It doesn't have the same upside as Bitcoin, but it's got a guaranteed, at some point, downside protection, upside yield. You're blending the thing and you're selling it to someone that wants to buy that. Are there people that want to buy it? Sure. Like in a way, MicroStrategy issues a bond, 6 and an 8% interest. And we buy Bitcoin with it. If you swap the two, you've given up the upside of Bitcoin in return for getting the guarantee of 6 and an 8% interest. And why do you do that? Well, because the government's paying you 1% interest. You don't just snap your fingers and change those structures in a day or a week or a month or a year. In some cases, those structures have formed over 30 years, 40 years, 10 years. 10 years is a short period of time in the finance world. So what you have here is investment firms that are able to create all their own financial products with any mixture and blend of risk and volatility and they can hybridize them with existing conventional assets